just wait and you will get it, that guaranteed return. Whereas if you take risk, then you will get over and above this, what is called risk premium multiplied by the risk. Higher the risk, more the return. So this is how it is carried out, and let us see. So like, the capital budgeting, I have already explained to you. The same thing is explained in my slide, that if present value is greater than, the NPV is positive, we should buy the stock. If it is not positive, we should not buy the stock if it is equal to that. The same thing in which is used in capital budgeting, it can also be applied in the valuation of equity stocks. And because we have to find out, when you buy the stock, it will be cash outflow, and when you receive dividends and over the period of time, that will be cash inflow. So what we do, that we try to equate it with certain discount rate, and discount rate, it comes from the not only the time value of money, which is the risk-free rate, plus the risk premium. And multiplied by the amount of the riskiness, the risk of the. So we use that. Higher the rate, less will be the value. Lower the rate, more will be the value. Let us take an example to understand this thing, and then we will have a general formula for this. Now you see here that the dividend, there is a company that which is expected to, let us say, give dividend in the first year, 4 rupees or $4. At the end of second year, it will give 4. Now, if this 4 rupees you will receive after 1 year, so this is year 1, let us say 4 rupees, let us say 2023. Then next year you will receive 2024, 5 rupees. Now, if you want to find out what is the present value of this after 1 year, then mean that the time value of money, then we have to discount it. So if you discount this, let us say that discounting is 15%. Based on the risk of that the stock, we let us say that we have used CAPM and we have found out that this is the rate. So naturally we have to divide by this 4 divided by 1 plus 1, 5 in the first year. So it will be that 1 rupee, 4 rupee which you receive after this, the present value, if you travel backward, it will be in today's value 3 rupees 48. If you receive 5 rupees after 2 years, and the same discounting factor is we just, so the value will be the amount, 100 rupees, it is given here that the price will be 130 plus 5 rupees. So we have added these, you can see, and divided by and discounted by this factor after 2 years. So this values come out to be this. So after adding this thing, so this is 3 rupees in the first 48 paise after discounting, and after second year, when you sell, the price is expected to be 135. So it means that the value of this stock currently is 105.56. And if the stock is selling at 100 rupees, that if you subtract from this, it will be positive 5.56. NPV is positive. So we should buy the stock because its present value of the flows is higher than the cash outflow. So this is a simple example of how we can find out the present value. Now we have taken 1 year and 2 year, but that any stock is there, then it helps. It's a future stream will be for a long period of time. Sometimes it happens that the dividend is expected to grow at certain rate. We have taken here that dividend is growing at 4, and in second year one will receive 5 rupee, and the price that will prevail is 130. So by discounting, it. So what we have done is that we have tried to discount it to know what is the in present value term. If you buy now, what is its worth? And naturally, if is positive, then we should buy it. Otherwise, we should not. So this is what is explained in my slide. I have already explained to you. Then you should buy them. So if we, this is a positive, therefore we should buy the stock if it is being sold in the market. Now what happened that this was the equation which I have used here. Dividend 4 rupees, 1 plus 1 in the first year, and then 5 plus the price that prevailed was 135. Let me just check it. 135. And then here we had 1 plus 1 second year, so on and so forth. It was third year, then 1 plus 1 plus third year, it will be an n number of years. So same discount. So this will turn out to be general form. And you know that dividend, if you assume that it will grow, it will for perpetuity, well, then we have to use it, the same procedure. But if it is a perpetuity, that dividend is 4 rupee dividend you will receive for forever, then simply it is a formula for perpetuity, that the 4 rupee dividend every year, then we discount it by this. If it is different for different year, then we have to, for example, we can also assume that this dividend is expected to grow by 5%. So for example, if it is 4 rupee, then in the next year it may grow by this, and the next year it may grow by this, third year it may grow by this, and so on. So we may have assumptions about that this cash flow which we are receiving, it will grow also. So that is why in the formula, what we can do is that we can add a factor of growth also. That for instance, if we assume that the dividend paid is 3.81 and it is expected to grow in the year 1, so that will be 4. In next year it will be 4.20. In the third year it will be. So it is like compounding. Now you are assuming that this is expected to grow at G is 5%. So this seems to be more realistic formula for the dividend of the cash flows are expected to grow in the. That is why in the formula we can add this part, that is dividend is expected to grow by first year, second year by this, and third year by this. If we simplify, then formula collapses to this. D1 K minus K is the capitalization rate and G is the growth rate. And for this formula to operate, K should always be greater than G. That is the, otherwise if it is, then this formula, for example, if K is higher than this, then this formula will not work. So that can, for example, if company is paying a dividend of 3 and the first year you will receive a dividend of 4 rupees, and this is expected to grow at 5% every year. So what we can, in order to calculate the price of a stock, we just write down 4 and required rate is 12%. The discounting factor, this is also called market capitalization factor. So in this formula, what we write it in decimal 0.12 and 0.05. If you do that, you will get a price of 57 rupees 40. If you find that the stock is being sold at a lower price than this, then you should buy it. If it is more than that, you should not buy it. If you are holding it, you should sell it. So this formula is known as the Gordon's formula, which is famous, that the dividend is expected to grow at certain rate. And because this G factor is a very, very important factor, I'm coming to this point. This factor is important because you know that I was discussing about the growth. You know that the if the company the is plowing back the investment, then the that is based on investment policy of the company, then this becomes very important factor also. But this formula is very sensitive. For example, slight variation here in the discount rate or the growth rate calculation will affect the price to very large extent. That is why one has to be careful. This factor, that is the capitalization factor, or the we can find out via CAPM. CAPM can tell us what should be the rate. Growth we can find out from the history of the dividend, if it is the company is there, that what has been the growth. And when I talk about the company financial statement analysis, then this is also kind of calculated by ROE, that is written on the equity. That is nothing but the retention rate, or that is how much dividend the company, and the multiplied by the return what gets on this investment. So we will discuss about this thing in the. So that is why the dividend which is not paid back when it is invested, what is the return on capital? So retention rate and multiplied by return on capital will give the return on equity. So that is considered to be growth rate, and in some cases we can calculate the dividend that over the years what has been the growth rate, and like that. Now this is one of the most important formula for calculation of the equity, and I will show to you that even the assets like Bitcoin, there has been attempt to value Bitcoin, that is very difficult to value. So but I will discuss about these things later, not now. Now this is the single period formula, that the dividend is given and the price after first year. R is the discounting factor. Multi-period, it will go, that if there is no dividend, so it will go. And zero growth means that there is, so this is the perpetuity, and this is collapses to the same thing. If there is any bond which gives the interest rate at perpetuity, same thing, same formula. Dividend here is dividend is. And this is a formula for constant growth rate, that we assume that the company will pay a dividend at certain rate, and this will grow forever at certain rate G. And for this, R should be greater than G for this formula. Otherwise, this will not work. This will be negative number if you do that. If it R is the G is greater than this, so it means that it will be negative value, which is not stock will not have a negative value as such. So that is the formula collapses. And this, as I said, that now in this formula there are various modifications. For example, we are assuming that the dividend will grow at certain rate forever, 5% forever. Now this may be multi-stage, and we assume that the dividend will grow at 5% for so many years, and after that it will grow into 7%, and then it will decline to another. So there will be multiple stages first, and then a steady growth. So that formula just to have be adjusted for for the growth of certain period, then plus the growth of the as specified, and then plus n. So it becomes unnecessarily complicated, and but that can also be used. So I am skipping that. I am using this formula, which is quite representative of the equity valuation. So let us go further and try to understand that this is an example that a company is there. Now, when I say that the price of equity, D1 minus R minus G, now you see that if you are given, this is the price of a stock, or what we call the price, this is the rate, discounting rate, growth rate of dividend, and this is dividend in the year 1. Now you see that this is the formula for where if you have 3 variables, you can. So in order to find out, for example, if you are given price, dividend, and R, you are asked to find out growth rate. One can easily manipulate this formula. Or any 3 variables are given, 4th you can easily find out. So by manipulating this, for example, in some cases, dividend the dividend is not given, price and this is given, you can easily find out. So let us assume that this is an example of the equity value, that there is a company, the expected dividend is per share is 2. Please why the word expected, because we do not know for certainty, which is, and has grown at 5% per year, so growth rate is 5%. The growth will continue in future, in perpetuity. If the cost of equity is 15%, that is the required return is 15%, find out the intrinsic value of the stock. You see that here 2 rupee is this, so same has been plugged here in this formula. Dividend R minus G. So this has been done here. 2 rupee is the dividend, minus 15% required return, minus 0.5, it will come out to be 20. Now you just change it slightly. For example, if you reduce the required return to 10, keep other thing constant, the value will. So naturally, higher the discounting factor, lower will the value of the stocks. So now this is the 20. If the stock is being sold in the market at lower than this, it will be good buy. One can buy. If it is more than, we should not buy it. If one is holding, one should sell it. So in this way, we can have this. The other, for example, if you are asked to find out expected rate, the formula has been just slightly manipulated here. Just simply will come out to be P and the price of stock prevailing period O and G. So same has been used. The expected dividend per share of XI is 5. The dividend expected to grow at, if the price is now 50, you are asked to find out from this. So this is given 50 rupees. This is 5 rupees, and this is growth rate is 0.06, and you are asked to find out this. So you plug these values, and when you solve it, it will be 16%. Now this is the required return. Same way you can use it, but I am not going to use it because I expect you that you know these basic things. Just a few examples I have taken here. Now, the point which I was explaining to you can be understood by this exhibit which is being shown here to you, that the same formula value that a stock is paying a dividend, in the first year it is paying 3, but it will 8% after 1 year, so it will grow to this, and the required return is 14%. And the growth is 8%, so price is 54. Now, if a stock is riskier, for example, 16% is the required return, so this price will come down to 40 rupees. This was the point which I was explaining. So if the rate of return is higher, the rate of, capitalization rate or the discounting factor, what you call it, is higher, the value of, because it's risky, its price should be lower. So so that is why these and G is also, for example, if you slightly change this growth rate, you can see that. Just I will suggest you that please keep in mind, keep in these changes when I do in Excel in my next class. then we will make changes there and we'll see the impact, how big impact may be there. Even a slight change in these values are there. That is why these inputs have to be used with care. It is not that otherwise a stock which may be fairly priced may become, unfairly priced, or which stock should be good buy, one may think that it is overvalued. So in this way, we can use this formula, and so now there are limitations of this model. Limitation of this model is that we assume that constant growth may not be valid. And another is that when G is less than K. So, and because that formula is that dividend R minus G. So naturally, if it is G is higher than this, then formula will become, for example, it is 0.15 and it is 0.8. So naturally, it will be a number which will be a negative number. Okay. So naturally, this formula will not work. Okay. And if the analysis drive an estimate and greater than G must be unsustainable, it will be unsustainable. For example, so that is why sometimes if you are assuming that growth rate will be higher than K, so this formula does not work, and this formula may not be valid way to understand equity valuation. But let me tell you that it is one of the most widely used method for valuation of equity shares. But and it's simple in the sense that the one has to find out the dividend and the required return. One can use CAPM, or another one can find out, and the growth estimate can come from either from the dividend growth or from, to be more precise, ROE, that is return on equity, which is nothing but the retention ratio multiplied by return on capital employed. So that is used for this. Now this is valuation method is called absolute valuation method. And you are trying to value a company in isolation with other companies. Okay. You are not comparing with other companies. There are some methods like P ratios, book value to market value, price to cash flow, and other, which are the what we call it the relative valuation or comparative valuation. For example, if take a peer group, peer company, so we can use some method like P ratio, book value to market value. So that is why these are called for comparison. And you should understand that price earning ratio is the price of the stock, market price of the stock, divided by earning per share of the stock, earning of the stock. So this gives, for example, if it is 15. So it means that in comparison to the earning, the stock B is 15 times. Now, if there are two firms in the same industry in similar, then one if has got 18 and another has got 15. So the company A is valued more aggressively than the B. So it can provide an idea about if they are similar characteristics or similar firm, whether their P ratio should almost, for comparison, one can have an idea about. The P ratio is one of the most important method for the valuation of the companies. In some cases, what happens that you do not have any history of dividend, for example, also of a company. That's not. So same company, a peer company can, what is the P ratio of that company which has, so that can also provide an idea about the valuation of a company. Now, the P ratio actually tells us about the growth opportunities of the company. If 15 is the P ratio of a company, then it means that it is expected that the company will grow by 15%. The earning will grow of the company by 15%. So this is one of the most widely, and in India, for example, the P ratio is very high, the overall more than 30. So that is some people are saying, like Robert Schiller, they are saying that it is unsustainable. So such a high P ratio is prevailing in market. Then there is another the method which is used for relative valuation is what we call price to book ratio. Market price of the stock divided by book value. Book value is that which is written there in the balance sheet. For example, the book value of a share is 10 rupee, but over the year this value may grow because of the retained earning and others also. So market price of the stock, and so this is called the price to book ratio. So now we may have two types of companies. The PB ratio may be high for some companies, and for some companies it may be low. So those companies which have got high P ratios, they are called value stocks. And those which have got low P ratios, they are called growth stocks. Now, for instance, let us put some number here. Let us say that market price is stock is 10 and book value is 10. So PB ratio is 10. There is another company, let us say its market price is 200, book value is 10, so PB ratio is 20. Now, normally this is classified as value stock and this is classified as growth stock. Now, the value stocks are those companies which are very mature companies, and they have a track record of sustained dividend over the years, and they do not have much reinvestment opportunities. Therefore, whatever profit they earn, they pay back to the shareholders. That is why market is not aggressively pricing there. So whereas these are growing companies and they have got high growth potential, therefore market is valuing these companies aggressively, and in company that is why they have got high PV ratios. So the PV ratio can also indicate about the valuation of a company, and one of the ways of classifying whether a good value, for example, if you want a constant stream of dividend and grow the income, one should invest in value stock, whereas you may not have a dividend history of these companies. These, for example, various companies and other, they have not the new companies or growing companies, because they have to make reinvestment, in the form for expansion, for acquisition, for other things, and therefore they do not pay back to shareholders of relative valuation. Then price to cash flow. That for now, just I will tell you only this thing, because when we talk about financial statement, and I would advise you that please go through your first year classes, whatever you studied in accounting, and should be aware of what is the balance sheet, what is the income statement, and what is the cash flow statement. These three financial statements, they are very important in understanding about the company and life, and the valuation also. Whether should, for example, we arrive at certain valuation method, but it has to be looked into also by looking at the company's fundamentals, and along with the industry and the microeconomy factors. So you should be aware of these things, what these are and what are these. For the moment, just I would like to point out that cash flow, that accounting system is based on for example, let me tell you a simple example, account receivable. So accrual basis accounting is that although a account you will write it that account receivable in your income statement, but actually what happens that you have not received the cash. They are accounts which you will receive in future. So, and for example, there is another. For example, if you use the cash for your investment activities, then plant and expenditure, what we capital expenditure. So it in income estimate shows a cash, but this may have been used. Similarly, one may have raised fund cash from financing, one may have issued new equity share. In cash flow statement, we look at that how much cash is available. There are three components of that: cash flow from operation, cash flow from investing activities, cash flow from finance. So that is why in valuation, the what is the free cash flow after adjusting this thing. That is why price to cash flow method is also used for valuation. And as I said that it's a accounting statement does not tell us about this. Income statement, other statement, they do not tell us. But if you look at the balance sheet, the change in the balance sheet at 2 time period in the cash will tell us that how much cash is available. So I do not know exactly whether it has been discussed in your class of accounting or not, but I assume I would advise you that please go through the balance sheet, income statement, and cash flow, because I'm not going to teach accounting to you. Because on this basis, we will have ratios as well and its interpretation. So right now, I will just tell you that, the cash flow is used because I explained in my slide. So the is used also as a valuation method. And let me tell you that cash flow from the income state, the earnings to cash flow, the journey of valuation has moved from that. In earlier time it was the case, but because that cash flow also, tells us the true picture. If the accountant may manipulate, the entries. So that is why the chances of manipulation in cash flow statement is very less. It is very difficult to hide. And that is why cash flow is also used one of the method for the valuation of the companies. Then there are certain companies, there are no earning ratio and earning ratio for some certain firm is maybe meaningless. What is the price earning ratio? So, and they may not have that track record also in that way. They may be. So for those companies, what is done is that price to sales ratio is taken. Price of a company share divided by the sales. So this is also one of the method, and for the evaluation of that. New companies, they may not have any earning as such, very new company, young companies, but because they are now just started. So that, like, various like Zomato and others, I mean, they may not have that much earning, for example, and that is why they look at the overall the food market industry and what is the share of that and how much sale they will. All these factors have been taken into account in valuation of those companies. So price to sales ratio may also be. And if the track record into the overall industry and then market share, that can help us. So that this is also used, one of the method. And please remember that in income statement, we start with the sales minus cost of goods, and then we arrive at the gross profit, that is and then subtract other like that. So when we take up, we will come back to this part also. And in some cases happen, there is no, for example, IT companies and other. So like valuation of a Facebook and others, price to hits or visiting some websites. So that is also used one of the method of valuation of companies and like that. because of the internet, because these were very new things. There was no valuation method available for that, how to arrive at valuation of each company. So this ratio has also been used. So these are some of the ways. We started with the discounted cash flow method, like when company is paying dividend, then how it is valued, and then uh, the the next thing was that which I talked about, that that was the absolute valuation of a company in isolation with what others peers are doing industry, and then we discuss about this the relative valuation, P, market value to book value, price to cash flow, and price to sales, price to hits. They are all used to understand the like. But price to sales also has got a limitation. Just read this thing. It has been drawn from very recent Money Week, because there is a column there. Uh, I wish I knew what a price sales ratio was, but I am too embarrassed. So there is always a column there where such I push. Price to sales ratio, it is saying, is the market capitalization of a company divided by its revenues. So a company that has a market value of 20 billion sales of, has a PBPS ratio of 2 point. This is sometime also known as sales multiple. The lower the number, the cheaper of the stock. The PS is calculated in similar way in other methods as price to earning ratio, market capitalization divided by the earning. But of course, sales are not the same as profits. So the PS may at first glance appear less useful as a gauge of whether a firm is cheap or not. How it can be helpful when looking at firm R chapter where earnings are temporarily depressed as a result of one-off factor, but which are later expected to return to a more normal. For example, cyclical, which moves with the business cycle. Uh, Comparing companies using may be more effective. It may also be used when comparing early stage growth stock operating the same. Again, these firms may be expanding but not yet making profit, rendering P rate useless because they are not earning profit. Therefore, we cannot use the P ratio. By comparing them, PS and investor can work out how much the market is paying for each pound or dollar of sale. However, the investor must ensure that any assumption they make about how will be in the future are realistic. A business with a low PS ratio but no prospect of average will be a poor investment. Also, with the P ratio, and PS does not take any debt into account. How risky the firm is. Generally, a heavily indebted company is riskier and less appealing than more than no debt, assuming that you are comparing with the same industry. Actually, that includes that you need to find out enterprise value, which I will also hint at later on, which add debt to the market value and divide it by sale. As with all ratios, PS should not be used in isolation. Naturally, it should not be used in isolation. What it is saying that if you those companies which are young and which do not, PS may be very important, or if their earning may be depressed maybe because of COVID, maybe because that thing situation, so that can be used. And moreover, but they do not tell about the riskiness of the companies. So because they price, and if a company is highly levered, so it's a very risky company. So there might be, that is all these. So that is why I thought let me share with you. So the so with this I have covered the equity valuation, but I will revisit this thing once we have taken up the fundamental analysis like macroeconomic factor, industry factor, and company level factor, and then we will look at these things once again. If you have any question, you can ask before I go further, before I close, because I actually had planned to take up bond valuation, but I will not be able to finish it. So tomorrow I will take a bond valuation and also introduce to you the macroeconomy and the factors and the sale, like that. But I would advise you, strongly advise you that please refresh your memories about the financial statements. I know that accounting, the is not cup of tea, but you do not have to be an accountant. You have to look at how can you read the financial statement. I'm not asking you to prepare an account, debit, credit, but you should be know what is the balance sheet, what are the component of balance sheet, what are the incomes, how, because, and what are the cash flow statements. Just to understand that, because the valuation of a company, they are based on we look at the profit, the operating profit margin and various ratios, like the liquidity ratio, the capitalist, the structure, and the activity ratios, and all these, the market valuation ratio, they are all derived from the financial, like P ratio. Naturally, it is based on the financial statement earning. So with this, I close, and we'll see you. Unfortunately, the number of students who are attending the class is even 50%. Good luck to them. But I have already, downloaded the attendance of the student, and I will let you know tomorrow who haven't attended any single class, and that will carry a penalty as well, because that although officially industry does not have a policy of attendance, but for in my class I will put some marks for attendance as well.